Good morning. Morning, everyone. Okay. Can you see? Can you hear me? All right, today I want to look at the last couple of handouts together. I sent you the answers to that one. So wait, what do you guys want to do? I didn't get any questions from you, so it seems like you're not having issues. Were you able to do this one? Let's see. Were you able to do this one? This is the one I sent you yesterday. This is a long one. I sent you the answers. I'm going to verify I sent you the answers. Yeah, it's just 5:20. I didn't send you the answers. Do you want this one? This one? Anything else? Is this? Okay. Okay, so this is a long example of whack. How many of you are doing whack for the first time? I asked this question before, but anyway, let me see. How many of you, this is the first time you see whack? You do 5 of risk and return. This is 4 or 5. So yeah, you want me to do 5? I think I should do 5 just because you don't have the solutions. And then I'll go back. What about that? I'm going to do 5 first. My file, hold on, my file is corrupted somehow. I'm sure that happened. Okay, I'm just getting organized. Give me a minute. Okay, I'm back. I'm just something happened to one of my files. I had to recreate it. It got corrupted. Hope that doesn't continue. Let's see. You guys have said some things. Okay, you saw walk. Some people say first time, and then Monica asked me a question. Review 1, tap M and whack. Here's a review 1, tap M and whack. Number 4, part B. Let me see. Okay, number 4. Review 1. Number 4. I think I'm not looking at the right place. Review. I'm sorry, I don't know which one you're referring to. You said review 1, do you mean review 4? No, it can't be review 4. Review 1, 4 is about NOP stock. Not sure that's the one. Monica. Review 1 capital acquisitions and then 4 copy. That is the review use. I'm sorry, Monica, I don't know what question that is. Maybe review 2? Okay, I don't know what question you're asking, Monica. Okay, so what I'm going to do is I'm going to start at I didn't put it. Sorry, it's taking forever, isn't it? There you go. Okay, this one. So this is Bree, is there any way to turn off the beeping door? See the beeping loud. Can I turn it off? Okay. All right, so this is what we'll look at. Okay, I'll answer that later, Monica. All right, for this one, how'd you guys do with this one? How'd you do? You don't have the answers, so what we're doing here is we are combining the market portfolio and T-bills along the security market line. And we're determining our new risk and return values for the portfolio. So this is the idea of moving up the line. And as I explained, all securities are on the line, all investment projects, all firms. Right, this is a security market line. And you plot the beta here, and you plot the expected return here. And what we're doing is for the RF here and the market portfolio here, we are creating a portfolio mixing risky and riskless securities and ending up somewhere in between here. And to end up here, you have to short sell the T-bills to end up here. above the market portfolio. So this helps you expand the market portfolio potential. Okay? So this is what we're doing here. So anybody know where to start with this? I just want to see if some of you are following how you handle this. So I did a lot of theory, not a lot of problems like this. And here, so T-bills and the market portfolio are the only two components of portfolio Y. Okay, so we just abstracted away from all other securities. T-bills may be held long or short. In other words, T-bills may have a positive or negative weight. So if you're borrowing T-bills, then they have a negative weight. If you're buying them, they have a positive weight. Right? Long is buy and hold. Short is borrow and then return at a later date. All right. $400 of portfolio Y is invested in the market portfolio. The portfolio Y is a total of $1,600. So what is the weight invested in portfolio Y using the market portfolio? So you're figuring out the weight XM when you do that. So the information here is to get XM. It's a weight of 400 over 1,600. You don't hear me? It's funny. Let's see. Is that better? Can you hear me now? Not sure what's wrong. John, check your end. Yeah. Test, test, test. Can you hear me? Anyone? Okay. All right, thanks. Okay, so what's this weight? So 400 out of 1,600 investment is how much? That's 25%, right? That's a quarter or 25%. We can use decimals. So if it's 25% invested in the market portfolio, how much then is invested in T-bills? F for free, risk-free. Remember, the weights have to sum to 100, right? So how much in T-bills? Very good. So since they had to add to 1, this has to be 0.75. Now, because you have those, and you have the information on the components, you have the expected returns for both. You could figure out the expected return. And you have the beta for both. What is the beta of T-bills? And what is the beta of the market portfolio So remember what the beta is. It's the sensitivity of the asset's returns to market returns. So if you're talking about T-bills, there's no relationship between T-bills and market. The T-bills return. So this is the return. This is the risk. So because there's no relationship, remember what beta is. It's the slope relationship. There is no trend between riskless assets in the market. That's the notion of it's not impacted by market returns. It's not impacted by the economy. No matter what, T-bills have a guaranteed return. So there's no volatility relative to the market. So this is going to be 0 always, right? That's how we plot it on the security market line. Right, and the market, the beta for the market is also plotted on the security market line. What's its beta? Now that is the sensitivity of market returns for market returns. This is a 1-for-1 relationship. The slope between them will be 1. Okay, and that's, you always see that in the graph. We always plot, here's BF, is here, the beta of 0, and the market beta is always 1. Okay, so if you didn't know that, now you know that. So BF0 and M1. So how does that affect the new BF, the new beta of the portfolio? So you can calculate a weighted beta to compute this, and you could either calculate the weighted return, the weighted average for the return of the portfolio, or you could use CAPM to get it. So let me see if you guys can do it without me, and then I'll show you the answer. Waiting for me? So what you're going to get is the beta of the new portfolio is the weighted average of the betas. But because this beta is always going to be 0 and this is always going to be 1, it turns out that the beta of the portfolio, of the combination, will always be simply the weight on the market portfolio. So it's just affected by the market portfolio contribution. So because XM is 25, the beta is 25. So the sensitivity of the combined portfolio is just the riskiness contributed by the fraction of the market portfolio. So, if you think about it, all you've done, you've created a portfolio between RF and the market portfolio. So what you've done is you've created something in between, closer to, so it's 25% in the market portfolio, it's 75% in the risk-free, so it's closer to here, you see? So that's the new thing that we created. It's with a lower beta than the market portfolio, which has a beta of 1, and it's a little bit higher than the risk-free portfolio. So this is why here. Got it? So we end up on the line. It is going to be on the line because we've created a linear combination of assets on the line. This line extends all the way here. It's just my pen makes a mess when I try and extend it for some reason. There. Okay. Now we could also extend it back. I could even go back here, right? Negative beta. Negative betas exist. Negative betas would mean what? What's an example of a security with a negative beta? What does beta mean again? It's the sensitivity of the securities returns with the market returns. So a good example of a security with a negative beta anyone? Nobody? Gold. Gold is a good example because when the stock market does really well, investors who don't have particular loyalties will invest in the stock market and they'll pull money out of gold or precious metals, let's say, investments. So that can be investments in the actual, in the bullion of gold, or it could be in some companies that mine gold, or it could be in mutual funds or funds that are made up of gold companies. Okay, so gold, silver, other precious metals have negative betas. You can see now if you look at the charts for gold, gold is at an all-time, not all-time, but in a 10-year high. And you can see that right now when the stock market is struggling. Okay, so that was extra information. So this is where we end up. Let's get back to the problem. So that's what you need to remember. So you can remember that as a formula or as a concept, that the beta of the new portfolio of mixing risky and riskless assets will be just the value of the contribution of the market portfolio. So now what is the expected return. You could figure this out as a weighted average of these two, or you could use CAPM to get it. So let's do that. So expected return of Y, I'll go back to my, I'll make a new clean page. Let me know if you need me to go back. So the expected return of security Y, the portfolio, is going to be the weight of the risk-free times the risk-free. So it's the weighted average with the market portfolio. Okay, so you can put these formula on your, you can add it to your formula sheet or wherever you put all your formulas. And when you do this, this is 0.75. T-bills is 0.04. The market portfolio is 0.25. And expected return is 0.12. So you get a weighted average. It's going to be somewhere in between here, between 0 and 12. Not 0, sorry, 4 and 12, right? Because it's in between these two. And so when you put this together, you get 0.06. And that's it. The other way you could have done it is using the beta. You could have traced through to the line to find out where you are. So let's do that. Let's use the CAPM. The CAPM would say that the expected return on the portfolio is going to be the risk-free rate, right, plus the markup above for every unit, sorry, of risk contributed. We're going to adjust, we're going to provide a premium, the market risk premium. So market risk premium is that. All right, so we know the market risk premium is, this one is 12 and this one is 4. So it's 8%. BY we already calculated as a 25%, and this one we already know is 4. So it's 4. You have to get the same answer. It's going to be the same. And that's going to be 6%. It has to be. So rather than doing a weighted average, we use the line of the CAPM to calculate it. Okay, why don't you guys try part B without me? I'll give you a couple minutes. How you guys doing? No answers? No idea? So you're shorted 800 worth of T-bills. And I mentioned in a note above, I said if you short, you use a negative. So what would be the weight on T-bills, XF? I wasn't talking. You were on pause. So here is the Y. This is the Y portfolio that we just computed. It's weighted more in the risk-free than the market portfolio. Now we're going to short T-bills and end up over here. Or we can extend this line out like this by shorting. So we're going to talk about ending up over here. So how should you end up there? So $800 worth of T-bills are shorted. So what is the weight on T-bills? So it's a weight of negative 0.5 on T-bills, and since the weights have to add to 1, that means what does it mean? I'm trying to move this. Oof. So what is the weight on M? What is the weight on M? The market portfolio, no idea. So if they have to add up to 1, so 1 plus the, XM plus XF has to be 1. weights have to sum. So a negative weight is when you short sell. What you're going to do is borrow the money. By borrowing a T-bill, so what you're going to do is borrow a portion. You're going to borrow T-bills. You're going to borrow T-bills and you're going to sell them. You're going to sell them and use the money and putting the funds towards financing the purchase of market portfolio. Okay? So when you short, you borrow the asset and you have to return it. What you do is you borrow it, you sell it, you get the proceeds, and in this case, put the money towards the market portfolio. So you're extending the potential for you to purchase the market portfolio. You're buying more than otherwise you could buy of the market portfolio. And then at the end, you have to return the T-bills. But presumably, you would have made a higher expected return. This would put you up here with a mix of shorted T-bills where the money was invested in the market portfolio and it expands or extends your new Y up here. This is Y for part B. Okay, so you can get a higher return because you've put, you've invested more in the market portfolio. The idea is that you're going to be able to pay back the T-bills and some and end up with a higher expected return. So mathematically, if you don't completely understand that story, mathematically that means that since the T-bill weight and the market portfolio weight must sum to a total of 100%, we use a negative weight for the shorted amount and put it towards the market portfolio. So the market portfolio weight is 1.5. And when you add those, you get 1. So what you've done is you've increased your return, but you've also increased your risk by putting more in the market portfolio. So with those weights, you can figure out the new beta and the new expected return that put you up there. So the two formulas, or we're working with 3 formula, right? We're working with there's this formula here, the weighted beta formula, and then there's the expected return formula, and then there's the CAPM formula. There are 3 formula that I've been using. So you can either, to get the beta, you can do the weighted beta. Remember that the beta is just the weight of the market portfolio. So that's how risky it is. It's just a matter of how much you put in the market portfolio. So we put 1.5 in the market portfolio. That means that the beta is 1.5. So we've extended the riskiness of our portfolio by putting more of the market portfolio in it. So mathematically, you could calculate that. Here, I'll put it back here for a second. You can take a screenshot if you want of the formula. Okay. So then the beta So the beta has to be, because of the formula for the weighted beta is the weighted average of the betas. And this one is 0, and this one is 1. So this one disappears. This is just 0. And all we have left is xm. xm is 1.5, so the beta is now, the new portfolio is 1.5. For the expected return again, we could calculate the expected return as the weighted average of the two returns using the new weights, or we could use CAPM. So the expected return you can do the weighted one. Oh, sorry. Because it's RF, we just use the symbol RF, right? And XM and ERM. Is that what I wrote here? Yeah, I put an RF here. You don't need all that. You just need, I can take that out. I got carried away, just RF in that formula. Anyway, I'll send you the clave so you'll have all the formula. It's not wrong, it's just that we treat the risk-free rate as a constant. And so I'll let you guys calculate this one. You tell me what it is. All right, So you got it, some people, 16%, very good, 16%. 16% it is. So what you found out was the return, you see? So for 1.5 here, you have to be higher than 12% here, right? Because the expected return on the market is 12, so you have to be up higher. So this will trace down to 1.5, and this will be 15%, 16%, where this one was, the original was 12%. All right, so we're working through the line. So we did that as an expected return. You could also do it with the CAPM, get the same answer. Okay, so you could do this with the CAPM as well. Market portfolio is 8%. The beta of Y is 1.5. And the RF was 4%. You could do it like that. And C is also 16%. Okay, all right, part C. Okay, try part C without me. Try C, try D. Long means buy and hold. Short means, I'm surprised you never heard these terms. Short means borrow, sell to obtain proceeds for purchase, in this case of the market portfolio. And then okay, so anyway, we're going to do the next problem that does long and shorting again, but when you know, okay, well, long refers to buy and hold. And when you know an asset is undervalued, when you know it's undervalued, you know the price is going to go up. So you buy it now for really a discount, and then you hold it while the price goes up. So that's what you do. So in efficient markets should be in equilibrium. There should be no profit opportunities, but intermittently, as information becomes available, and if people have access, investors or fund managers or banks, they have knowledge of these mispriced assets, they can take advantage. And one thing to do is, if you can identify that asset is undervalued, that means the price needs to go up to adjust, to incorporate appropriately the inherent risk, right? So if it's currently undervalued, the price is going to go up. So that means then that you should buy it, because you're going to buy it for a discount relative to the price going up. If an asset is overvalued, you believe it's overvalued, other people don't, you can make an arrangement to borrow it. You borrow it because you believe the price is going to go down. So you borrow it, you use the money, you sell it, you turn around, you sell it on the market, and you take that money and do whatever you would do. In this case, in the story we're telling, we're putting it towards the market portfolio. So we're taking riskless asset proceeds and we're putting it towards the market portfolio to extend our, although we're putting, contributing more risk to our portfolio, we are hoping for the higher return. So what you have to do on the other side is, though, you have to return the asset at a later date, the date that has been predetermined in the arrangement. So you short assets when an asset is overvalued. I made a video about this, and I'll do the next example is about this, is the same topic, longing and shorting. So properly pricing assets and then making the decision to buy and hold if it's undervalued, or short, borrow, use the proceeds, and then return it when. So how will you return it if you don't have it? Well, you have to go buy it, right? So at the later date you go and buy it, but the price has gone down, so it's no skin off your back. You just go buy it for a cheaper price and return it. So yeah, if you have time, I know it's been really busy these 3 weeks and you guys have been doing an amazing job, but if you have time in the rest of the summer to watch that film, The Big Short, or read about short selling, I think it's really important for finance students to understand short selling. Okay. Okay, you're working on C. So for C, Okay, so now we're going to work a little bit backwards. We have an expected return of 26. Oh, that's really high, right? So that's really high. Looking back at our graph, that, you know, we're only with 1.5 of M, we're at 16. So 26 must be way up here. So that's short selling of the riskless asset, the T-bill. That'll put us way up here. And so we need to find that weight. The best way, using the information you've been given, solve for the weight. So I'm going to use this formula here. So that formula says the expected return on the portfolio Y is equal to the weight on the risk-free times the risk-free weight plus the weight on the market portfolio times the expected return on the market portfolio. So you need to solve this. 0.26 equals, we don't know what this is, risk-free is 4%. XM is, well, we want to find that too. And the expected return on the market portfolio is 12. All right, so we have one equation and two unknowns. Do we have another equation that relates these two? Does anybody know how I do this? Before I give it to you like that. Nobody? Come on, come on, come on. Nope. Well, CAPM, could you use CAPM to solve this? If we use CAPM to solve this, I'm asking for a relationship between these two here. The weights. CAPM would be, what would we need for CAPM? CAPM would be like this. So in the case of CAPM, we would have, like, we know all of this and this, but do we know beta of y of this? We could solve for beta of y and work backwards. That's a whole different approach. Yeah, Alex deleted his comment. So I just want, what is the relationship? What is the relationship between those two? Right, so we know, so a second relationship is that we know the weights have to add to 1, right? So we know, actually I'm going to erase the CAPM because that's a whole different approach, which we'll do that too. So XF plus XM equals 1 is the other relationship. So there's the two formula. What I can do, the easiest way to do this is to substitute this into one of these, right? So let's see. I will substitute 1 minus XF is XM. How about that? So 1 minus XF. So I'm going to rewrite this as Okay. Now solve for XM. What do you get? You're looking for the weight on the market portfolio, and it should be pretty big. I mean, not huge, but bigger than 1.5, what we saw in the last problem. And you know, as long as you're consistent, you can use the decimal version or you can use the percentages. $2.75, very good. Very big number. So that's 2.75. So because that's 2.75, you can plug that back into here to figure out the negative weight of the T-bills. So if that's confusing for your brain, just put it in here. XF plus 2.75 equals 1 and solve for T-bills. Good. So T-bills are 1 minus 2.75 or negative 1.75. So those are your two weights. All right, now go back and calculate what you need. So we need, so I'm going to put these numbers in here. So this was negative 1.75, and the other one is 2.75, and now you can get the values. I'll go back to my calculations. This is how I got it. So this is using the expected return formula to find the weight, and then plugging it back into the second formula, that the weights sum to 1, you can solve for the return, sorry, the weight on T-bills. And now I'll give you some time, work with that and calculate XM, and calculate the beta of Y. That's what I asked you for, right? So now you can calculate, well, this is just 26. You're just going to find this one. That's right. So this is 26. Okay, so you're figuring out portfolios along the timeline, portfolios made up of risky and riskless asset. So we've simplified the world into risky and riskless assets and said that all other assets could be, well, all assets are on the security market line. If you find an asset that's out of equilibrium, investors could just create an asset with the same risk on the security market line, forcing all competing assets onto the security market line. Right. Since remember the formula for the beta of the portfolio, the beta automatically will be the same as XM. So beta Y is always just the weight on the market portfolio. So this is just 2.75. Remember that result when you mix the market and the riskless assets. Okay, so keep going. How about how much money then is that in T-bills? How much money in the market portfolio? How do you figure that out? Remember this result, right? This one came just from, if you think of the weighted beta, that will be the conclusion. How's it going? How do you figure that out? You don't know? So these are the weights, right? So they're just the fraction or the portion of the investment of the $1,600. So to figure that out, you just take the 1,600 times the T-bill weight and that tells you how much you're short selling T-bills. So what do you get? Right, Alfonso. So that's going to be, if you multiply those together, it looks messy. So if you multiply 1,600 times negative 1.75, you get 2800. So this is the value of the short sold T-bill. So you borrowed this amount and sold them to get this money, and then you put it towards the market portfolio. So you put this full 1,600 towards the market portfolio plus the 2,800. Okay? Also, the weights will give you the same answer. If you use 2.75 times 1,600, you'll get the answer of 4,400 in the market portfolio. Okay, so work with that. These are dollars, and those have to add to 1,600. Okay? So try part D if you haven't already. I want you to figure out the standard deviation. The standard deviation of the market portfolio. Sorry, the standard deviation of the market portfolio is 0.32. Figure out the standard deviation of a new portfolio Y. And I give you the formulas to do it. You remember this formula. This is the formula that we discussed on how to find the variance of a portfolio of two or many more securities. So I'm going to get you to use it. Now it simplifies dramatically here because the correlation between the risk-free and the market portfolio, remembering I told you there's no relationship, right? The T-bills, the return on the T-bills is not determined by the market portfolio, and those are predetermined in an agreement. So these are bonds, right? These bonds, they have an arrangement all predetermined in the indenture certificate, like the bond agreement, right? So the contract already stipulates what you're going to get as a return. So there's no correlation between market returns. So that whole part of the formula falls to zero. Remember, this is covariance, right? This is the covariance. This is covariance because let me just write that out for you. So you remember this formula, right? It's the weighted, so that the variance, it says the variance of a combination of assets is the sum of the variances with their weights squared. I'm going to explain why if you go back to that video or see those formula when I was deriving them. That's what that comes from. And this extra piece only exists if there's covariance or correlation between the securities. In this case, there's none. Now, the version of the formula that you saw, this was just 2, would have been 2xf, xm, and then covariance, covariance RF, RM, right? But what happens is, remembering that the correlation is the standardized covariance, you can replace with the covariance correlation here. Anyway, these are the same formulas. I'm going to write it as with the symbols. Oops. Oh, I can't get rid of it. Simply, let's do that again. This will be 2xf, xm, sigma fm. That's the covariance in the Greek letters. And I explained to you the other day and a few other times that the covariance standardized is the correlation. So if I wanted to find the covariance, I could just take the correlation and multiply. Actually, I showed you just yesterday, I think. All right. So anyway, this all simplifies anyways because this term is 0. And because the risk-free variance, the assumption is for the risk-free, RF is the return, and it's there's no variation. So sigma f is 0, and then beta f is 0. Okay, so that's what risk-free means, that there's no standard deviation. Even though you saw historically there was some variance over time, but we stipulate that the T-bills in this course, when we solve these, when we talk about the capital asset pricing model, we assume T-bills have 0 standard deviation, so 0 risk, 0 beta. All right, so this, anyway, the point is that this simplifies to this formula. So the standard deviation is just the variation contributed from the market portfolio. I tell you the market portfolio standard deviation, so you should be able to figure out the portfolio-wise standard deviation by just multiplying. The beta of y, remember, will just be x of m. And what would be the correlation? So this is a new portfolio made up of risky securities and the riskless one. I've shown you how to compute the standard deviation. So standard deviation of y is equal to xm sigma m. So this is just 0.65 times 0.32 or 0.208. Beta of y is equal to just xm, and this is 0.65. Why am I getting 6.5? Because remember, xf plus xm is 1, and they tell you they're putting 35% in T-bills, so xm must be 65. And finally, what is the correlation between the new portfolio and the market returns? Remember, the T-bills contribute no risk. So all you're looking at is or variation. All that's variable, it comes from the market portfolio. So the correlation of y, which is really just the variation in the market portfolio, and relating that to the market portfolio in this calculation or this correlation is just 1. I can prove that mathematically. I can prove that mathematically, showing you beta y is equal to what? It's the slope, right, of the security y, this is the portfolio, with the market returns, which is just sy over sx. X, the explanatory variable, is always the market portfolio, and we always put the asset on the y-axis or on the vertical axis. So this is the formula. So from here we can capture correlation with the beta. I did this the other day. So correlation then is equal to beta y sigma m over sigma y. So if that's the case, all I did was flip this around, solving for correlation. Now since beta y is just xm and sigma y is xm sigma m, all this stuff cancels. So it's exactly as I explained. The only contributing factor is the market portfolio. That's the beta of the new portfolio y, made up of the market portfolio and risk-free, but the contributing risk is only from the market portfolio, and the bottom is just a fraction of the market portfolio and its risk. So these all cancel, 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 cancel. It doesn't give you 0, it gives you 1. Got it? Alright, so I said a lot. I'm going to send you the clave so it's nice and neat in your notes. But that is done. I'll leave the last question for you to answer. I'll send you that in the solution, part E. All right? So try and answer that for yourself. I'm going to do the second problem as well. How many of you have already solved the second problem? Make the second part of this sheet. This one. Anyone done it? We can work on this together. I hope this helps clarify what we've been doing. I hope it doesn't confuse you anymore, but maybe this last exercise will help solidify what you understand. So no one's done this? All right, what I want you to do now that we've done part one with the first question, I would like you to try and fill in this column and then this column, right? So what is this? This is the formula for beta, the slope between returns, in this case, any asset in the market portfolio. So you're figuring out the beta slopes, and then you're using the beta for through the CAPM to properly price these assets. So these assets are out of equilibrium. So they're off the security market line. So this star means you're going to find them on the line, and then we're going to compare them and say, is this above the line or is it below the line? And then say, is it overvalued or undervalued? Okay? So try and fill this in. At least do one. Let's see if you guys, let's just do the first one. Let's do A first together. So let's do A together. So it's just a matter of using the information given. So the beta of asset A is equal to the correlation. So these are negatively correlated assets. Times sigma I, so that's 10%, divided by sigma M, and you're told sigma M is here, 15%. Okay, so it's 10% divided by 15%, and that will give you your beta. So that is the sensitivity of asset A to market returns. So I get negative, so this is a negative beta, and as I explained, you can have negative betas. It means that the assets are negatively correlated. Remember, the correlation is negative, then the beta will be negative, right? Because the standard deviations will always be positive. Standard deviation is positive, it's a square root of the variance, so a square root will always be positive. So negative correlation, negative beta, and I get negative 0.2867. Okay, so it's possible. So now I should actually make you plot all of these as well. Now let's get from the CAPM, let's get the equilibrium return. To do that, you compute, so for A, and I'm going to call it A star, this is equal to the beta, which is negative, not beta, sorry, RF. RF is, you're told here, the risk-free return. T-bills, right? It returns 3% and market portfolio is 8.3. So let's keep those in mind. So here, this is going to be 3%. Just ignore this. I can't get rid of it. So this is 0.03. And then plus the beta is this negative 0.2867 times the market portfolio. Oh, we should put the market portfolio 8.3. Wait. 0.8.3. 0.083 minus 0.03. So the expected return is, when you put it all together, very small, $1.4807. All right, so you guys try the rest of them. There's 2 more, and then we'll plot them and analyze them. So I'll give you 5 minutes. Okay, I'm back. How'd you do? What are you finding? So you're using, to solve this, you use this formula. Putting together here, the correlation is small but positive. 0.1 times 15% divided by the market portfolio's 15%. And you get 0.1. That's the beta. And the expected return you'll get using the CAPM, so on the line it should be 3.53. For C, using the information given, you should get, well, what do you guys get? Tell me. Anybody on C? Nobody's on C? No one? Very good. So C would be 0.3733. And the expected return for C? That's right, Alex. Good. So very good, Monica, Alex, Alfonso. Here we go. This one is 4.9787. Now you don't have to draw this, but I like to draw it. You don't have to draw it because you see a pattern here. So these are all percents, right? So the pattern is that on the line is consistently below the current values. All right, so these are, so the values that they're valued above the SML. Okay, so out of equilibrium, these are out of equilibrium. Out of equilibrium, they're valued above the SML. So what does that look like? Actually, wait. So this is RF here where it crosses, but then we need to go all the way, right? Because we have a negative beta to deal with. See that? So this is beta I always, and this is expected return for assets. Any asset should be on this SML. Security market line. And we found that this one needs to be, this is RF here, and this is you were told 3%. And then A is found to be, so this is A here, at 1.487. So let's say this is A, so it's lower, right? 1.487. So that's A star. I mean, that's the value. This is where it should be. Okay. I'll put a star. So that's where it should be. Where is it currently? It's currently at 2. So A, the actual A, is for the beta of, let me do that in a different color. For the beta for A being negative, we find A on the line here at 1.487, but it's really over here currently. And I can't, let me see. If I just put a red dot, that's supposed to be 2%. Okay, so this is the current A. So what has to happen is, or what happens is, at this level of risk, this negative beta, we're currently here. Investors looking at this level of risk will consider, ones who are already invested are happy to be there, right? For this level of risk, they're getting higher return than other people who are combining the risk-free security in the market portfolio to end up here. So what's going to happen is that people who are only getting this level of return currently, or expected return, are going to invest in A. Right? So they're going to buy A. They're going to look for A. They're going to offer higher and higher prices for A, the asset, if you think of it as a security. So what's going to happen when we consider the price of A is going to go up. And this is the same as the expected return going down, provided our assumption that dividends would stay the same. So for to change nothing else, all else equal, ceteris paribus, the expected return goes down and puts us here on the line. Okay, so this is out of equilibrium and we should end up on the line. So remembering assets above the line are called undervalued. Because they're undervalued, investors will be able to make these calculations and instantaneously adjust markets by properly pricing, offering higher prices to the point that the expected return falls and puts us on the line. So you would buy and hold, this is long, all these assets, they're all above the line. Okay, so they're undervalued, so you should long all assets. Because the price is going up. So that's the same discussion for all of them. All right, so you guys learned something? Sort of a review of what we did before. I guess you never saw a negative beta yet with me, but maybe you've seen it before. So then I want to then turn to review 5 and maybe set you on the right track with review 5. Review 5 is like what we did yesterday, except we have 3 types or 3 contributions, because you have investors who are common stockholders, preferred stockholders, and bondholders. Any more questions about this before I continue with the latest? No comments? Okay. This is review 5, sorry. Review 5. Okay, so all this information, I tease apart the information in the solution and then go through solving for WACC. What you need for WACC are the expected returns of each component, and you have to figure out the value outstanding of each component. You need market value, right? So you're told that NC Corp has long-term 20-year to maturity debt with a book value of $736 million in bonds. Preferred stock with 1 million shares, book value of 100 million. And common equity of 44 million shares with book value of $1 billion. So that's 1,421,000,000. The interest on its debt is about 72 million per year with annual payments. And debt is worth $834.18 per $1,000 bond, right? Because that's the face value. Preferred shares are selling for this price, paying a constant dividend of $6 per share. Common shares pay a dividend of $4 per share this year and sell for $32 per share. The common dividend is expected to grow at a rate of 5% per year. The income tax is 50%. So, with all this information, I'm going to open up the solutions. So I tease apart all the information. What you need out of each is to get the returns, right? And their market value. So let's just start. Let's go one at a time. There's lots of information here. Let's start with the bonds. So the book value of bonds are through $736 million. They're $1,000 value. They're $1,000 face value bonds each. So that means there's 736,000 bonds outstanding. The market value per bond, the debt is worth, you see, $834.18 per bond. So that's the market value of the bond. So there's that many bonds, and that's their price. So you could figure out the big B that way, which we do later. Okay, so I didn't put that here. So for the market value, I calculate this times this. Now let's look at the return, the rate of return on bonds. You're told that the interest paid, the interest on its debt is about 72 million per year. So that's the interest paid. So we're going to, okay, so then maybe you've not seen this before, but now you see it. So what you are going to do is figure out the coupon rate without the direct information. And you can do that with information on the interest paid divided by the number of bonds
oh sorry, the book value. So this estimates, so this is like your estimate of the coupon rate. So this is maybe new. So I'll probably tell you that in a test situation. I'll give you that to remind you. So you've estimated the coupon rate as the interest to be paid this year divided by the book value. That's the coupon rate. So that's what we're liable for, right? The firm is liable for. Now, if that's the rate, then the payment will be 1,000 times that, or $97.83. It's a 20-year bond, you're told, and you know the face value is 1,000, so you can solve for the yield to maturity. It's an effective rate, it's the effective annual rate. So you're going to solve this. The only thing on the bonds that you might not have realized is how to get the coupon rate. Okay, so interest paid, you can make a formula for yourself. Interest paid over book value. And so doing it this way with 20 years and say interest payments, we've pretty much rounded it to that's the interest paid over the year. We're not going to treat it like a semi-annual paid bond or anything like that. There's no information on that. So when you solve this, N is 20 interest you want to get, so don't put anything. PV is this price, and so that'll be a negative, but then put payment and face value as positive, and you'll get this rate. So this is your return to debt. And what you need to do is, in the formula, when you put it in the formula, it's 1 minus TC of that. Okay, so this is pre-tax, before tax debt, or pre-tax cost of debt. That's what we'll call it. Okay. All right, let's look at the preferred shares. So this is where we're headed. We're headed to calculate this formula where V is B plus S. We need to find B. We have this, we know this. We need B so we can find B and V, S plus B. So, well, it's actually V is B plus S preferred plus S common. So, where do we get B from? Well, B is the market value of bonds, right? So we need how many bonds there are. We figured that out. And this is the market price, so this is the B. Market value of bonds, of debt. Let's look at the preferred stock now. Preferred shares. Oh, let's go read from the above. All right, so preferred stock is $1 million shares with a book value of $100 million. Okay, so we have the number of shares, and that's the book value. Common equity, so that's common. common. Payments. Preferred shares are presently selling for $85. So so there's 1 million shares, and this is the market price. So we can figure out the SP, right? Constant dividend. They get a constant dividend of $6, which we need information on. And now we want the rate. The rate of return to stock, preferred shares. The way we'll calculate that, so maybe you've never seen these before. So the way we'll calculate that is the dividend divided by the price per share. So this is like a return on equity for preferred shares. So there's another expression for you. Okay, so for preferred stocks, we just take the dividend, divide by the price, and that's going to be the return that we use. So this is a different set of information than we used before to calculate the return for preferred shares this case. All right, so this is the return, and this is the market value because there are 1,000 shares. Sorry, when I say 1 million shares at the market value. See, this is the book value, but this is the market value that we need for the WACC. So we have to take the price, current price, times the amount outstanding, and it's $85 million. Okay, now let's do common stock. Common stock, you have the information, the book value, and you have the market value per share, which is, you're told they sell for $32 right now, and there's 44. Hold on. Book value, how many shares outstanding? Let's go see that. 44 million. Common equity, 44 million shares, you see? So there's that information. So it's $4 per share, but it's growing. So the next period is going to be 4 times a factor of 1.05. We divide it by the price and we add G. What is this? Do you guys recognize this? So we have seen this before. We did deal with this a couple times already. What is this? How am I, what model am I using to estimate the return on common stock? What do we call this? Anybody? Come on. So we learned CAPM. We learned valuing with present value of future cash flows. And we learned another way of calculating the return to equity. Anyone? Come on. So what is this? This is R equals the dividend, or I'll call it C1, over price plus G. No. So it does come from the perpetuity, the growing perpetuity, but the way that I've written it has a special name. What do we call this? So yes, it's the growing perpetuity, but I'm solving for R or I. I'm going to put I here. It's called, starts with a D. What is it called? Come on. Somebody. Nobody? Nobody. It's called the Dividend Growth Model. Very good. The Dividend Growth Model. We use this when we want to estimate the return given the assumptions of constant growth. We know the coming dividend and we know the current price. We can use this to estimate the interest rate for the subsequent period of time. Okay? So it does come from the growing perpetuity. I'm just looking for a different variable. I'm looking for the interest rate. So that's why I use that information here. So if I gave you this type of question on a test, I guess I would give a little more instruction so you know what to do, but you should know what to do given the information available, all right? All right, so really the only new things here on this page are that I added a second class of assets for the firm, this preferred shares, but I did give you the formula for that the other day. And I computed the return as like an earnings per share sort of thing. This is the return for every dollar invested. So this is the dividend over the current price. And then this, to get the coupon rate, I used an estimate of the interest paid over the book value. So I'll probably just give that to you just to avoid confusion in the future. So that's it. The rest is straightforward. We have the market value for each of them. This one is just the price. It's always, market value is always priced by asset or the securities outstanding, the quantity outstanding, and then you put it together in a ratio carefully. Sorry. V is summing all the market values together. Now, with the WACC, you should be able to calculate the WACC and use it to determine if a project is profitable. Should I give you more exercises on WACC? I think I might have some. All right, so I'm going to stop there. It's too late to start a new material. I'm going to send it to you. And then tomorrow I'm going to focus on the new material. But what I want you to do is be really good at the old stuff so that we don't have to backtrack. So let me know if you have any questions right now, or you can email me about any questions that you have. Are there any other of the handouts that you need help on? I need to post connect. I didn't post it yet. You have quite a bit of problems, don't you? I'm just looking. Okay. Okay, so the test will be focusing just on this, on the statistics, right? And the CAPM, and the WAC. And I'm going to do some theory with you on capital structure tomorrow. It's not going to be hard. It's going to be just to complete the topics. You guys are quiet. I'm going to let you go early unless you have questions or you want to make special requests. I'm going to look at Monica's question from the beginning. She asked me about review 3, question 4. Let's see. Oh, this is review 3, question 4. And the question was, for the NPV, I use 1 minus the interest rate. Okay, the reason for the NPV using 1 minus the interest rate, the tax rate, is because all you have are incremental revenues. So these are all taxed, so you have to pay tax on them. So that's why it's 1 minus 0.4, Monica. Right? Is that all right? Remember, we have to work with net operating cash flow, so net of tax. Don't forget that. We're still working like that. And there's no tax on the initial investment. Or did they put a tax on it? Let me see the solutions. Did I put a tax? If I put a tax on the initial investment, then I didn't expense it. I didn't use it in depreciation. Let me see what I did for the. Right, so I just treat it like the net present value. Well, I haven't included anything for, I haven't treated the initial investment in any special way. But just, I have to pay tax on the incremental revenue, so that's why it's 1 minus 0.4. Any other questions? Yes, I'm going to send the solutions because I know my notes are really messy. My old iPad, it's not picking up the stylus as nice as I'd like. So yes, I will send those. What else? Any other comments, questions? I've given you guys so many problems. I don't have many left for the exam. I have to start making the exam now. I need time to be creative. Yes, it's going to be similar to the other exams. Oh, are you referring to the case? I might have elements of a case. The case is really hard to grade. So the grader is struggling. We had to verify our answers so many times. So I put elements of a case, so you need to remember how to do those things that we did in the case, but I won't give you a whole case. Carola, I'm answering your question, I think. So if anyone just wants to go, you guys can go. I'll just stay on for 5 minutes to answer questions if other people have questions. Yes, I'll just stick around. Bye for now, but I'll be here for people who have questions.